Hello, I'm Ron Wirtz, editor of the Fed-Gazette. There used to be a time when the very mention of public pensions would have you reaching for the remote control, or maybe clicking out right about now. But there's something about an economic collapse that can make even the most arcane financial topics seem more relevant, even interesting. So it seems with retirement programs for local and state government workers. About a half-decade ago, many public pension plans were financially sliding. Aside from some modest tinkering, the general gist of solutions at the time was to leave plans alone because public pensions are geared for the long term, and they would right themselves without any drastic measures. Fast forward to the present, and public pensions today are in even worse shape, and many have crossed an unofficial line in the sand in terms of their financial health. The problem, in a nutshell, is that pension liabilities have been rising steadily, while pension assets have mostly flattened or declined. In this aggregated chart of 5 major Minnesota pensions, assets and liabilities should be relatively similar, or at least taking a similar trajectory. So funds would be available in the future to pay retiree benefits. That's not the case here. Instead, liabilities are growing much faster than the assets. The health of a pension can be seen in its funded ratio. In other words, the ratio of assets compared with liabilities. A ratio of at least 80% is a fairly crude but widely accepted benchmark for pension health. Not including the Wisconsin retirement system, which is roughly as big as all other district public pensions put together and fully funded, the funded ratio of other district pension plans runs the gamut, as you can see from this chart, from 31% for Minnesota legislators to the high 80% for a couple of South Dakota plans. Combine all of these plans together, and they had a funded ratio of 78% as of 2009, which translates to $20 billion in unfunded liabilities, all of which is backed by taxpayers. Many point to the stock market collapse in 2008 and 2009 as the main culprit, when plans saw asset losses of 20 and even 30%. Most also had negative investment returns at the start of the decade thanks to the 2001 recession. Though most plans expect to earn about 8% annually on their assets, none of the biggest plans in the district has come close to earning that, as you can see from this chart of 5 and 10-year returns. But the problem is also more subtle and chronic than investment losses. Suffice to say that decision-making is not always aligned with long-term fiduciary needs of pensions. For example, average retiree benefits have grown much faster than the rate of inflation. Many benefit enhancements occurred in the 1990s when pensions were seeing strong investment gains and funding ratios were much healthier. But benefits were guaranteed, regardless of funding status. Higher pensions aren't automatically a bad thing either. There's an argument that pension enhancements were necessary to keep a skilled government workforce. But that's a different argument, and whatever your opinion, the point is that better pension benefits cost more money, which governments must set aside, but they haven't, and catching up now will be increasingly difficult given extremely tight state and local government budgets. Minnesota offers a pretty good example. Government contributions to 5 large plans, which cover most local and state government workers, including teachers, have risen by about $300 million just since 2003. But they still fell another $300 million short of contributing what they should have. Plans have also failed to share risk or otherwise install mechanisms that might stabilize plans before serious problems develop. A good example goes back to investment strategies. Over time, plans have assumed more risk with their portfolios to assume higher returns. That's mostly been a good strategy, until recently. And when returns fall out of whack with their long-run assumptions, and funding ratios fall, something's got to be done. Most often, taxpayers and existing workers are expected to contribute more to pensions. Retirees, for their part, reap most of the reward for this riskier investment strategy, because those higher return assumptions hypothetically cover most of the long-term costs of a more generous pension. But when returns fail to materialize, retirees are largely absolved of any real risk. They no longer make contributions, and their promised benefits have strong legal protections. The severity of the problem is hard to gauge exactly. We're talking about predicting the future, and few plans are imminently insolvent. And as the saying goes, time heals all wounds, and maybe even pensions in this case. Much of the problem could ease if financial markets go on another hot streak, but that's not widely expected. And if it doesn't happen, the size and scale of unfunded liabilities will likely get worse before they get better. The good news is that lawmakers have taken unprecedented actions of late to fix problems. In a few plans, they've installed triggers that automatically increase contributions or decrease annual adjustments based on funding ratios at the time. But most of the repairs to date involve significantly higher contributions from local and state governments, and by extension, taxpayers, as well as from employees, which could hardly come at a worse time. So the bad news is that an increasingly costly pension system will get even more so, and that's if the fixes work. But if they don't, then problems will compound, and the fiscal tightrope already being towed by state and local governments will become even more precarious. For much more detail on public pensions in the 9th District, see the January issue of the Fed Gazette. And thanks for watching.